Hello everybody, Jamie Trull here, your favorite CPA and profit strategist. And today we're going to be talking even more about the employee retention tax credit. I know, I can't believe we're still talking about this too in 2023, but it is still a thing, and it is still a thing that you can claim. However, there are a lot of watch outs, and that's what we're going to talk about today. We're going to talk about what the IRS has been warning about. We're going to talk about how to know if you qualify, because there are a lot of high pressure companies out there that are targeting companies, telling them that they qualify for ERC, and it can be really difficult to tell fact versus fiction when you're talking to these companies. So whether you've already applied for ERC, maybe you've already gotten your employee retention tax credit, or you're considering it because the time is starting to dwindle down, you want to watch this. This is a really important video to watch. We're going to talk about who actually qualifies for it. And really quickly, it's important to say that there are two different ways to qualify for ERC. Unless you are a recovery startup business, we're not going to talk about this here today. But if you were an existing business in 2019, there are two ways for you to qualify for this. You have to, first of all, though, before we even get into the two different ways, you have to have employees that are not yourself or your family members in order to qualify. So if that's not you and someone else is telling you that you qualify, ignore them. They are wrong, okay? You need to have employees, not contractors, actual employees that you paid that are not family members or yourselves or owners in the company. If that is you, then the two different ways that you can qualify for the ERC. Now, you can qualify for this in 2020, although that's starting to roll off now for your timing to be able to claim this back into 2020, but you can claim it for the first 3 quarters of 2021 as well, depending on when you're watching this video. So this is still something to know. Now, in order to claim the credit though, you either have to have a significant decline in your gross receipts. I'm not going to get into all the specifics of that. If you want to know if your gross receipts will qualify, the best way to qualify is through gross receipts. It's a lot easier to prove. So if you haven't gotten my calculator, jamietrull.com/ERTC, we've kept it at $27. You definitely want to have it if you don't already. There is a tab in there that will determine whether you qualify based on a drop in gross receipts. That's the easiest and best way to qualify. The second way you can potentially qualify though is with a full or partial shutdown by government order. We are going to talk more about that with my friend Kristi Stone. She's going to come on here in a little bit because she has been in the trenches doing the work with actual business owners on this. She has a lot of thoughts around what actually qualifies here. And this is the one that tends to be more, I won't say open to interpretation, but more easily exploited, we'll say. So sometimes companies are taking really aggressive positions on this, and you need to be aware if you are somebody hiring another company, especially if you're paying large amounts of dollars, perhaps percentage fees, which I'm going to talk about here in a minute why I don't like, to do this work for you, then you need to know and feel confident that you actually do qualify for this. This is not something you want to quote unquote apply for. I've heard some business owners saying, well, I've heard my friends who are business owners have said they just applied for it and they got it. So, I didn't think I qualified, but I'm going to go ahead and apply and see if I qualify. Well, unfortunately, it doesn't work the same way that it did with PPP, where there is kind of this approval process, and if you don't qualify, you won't get the money. In this specific case, the IRS isn't checking whether you qualify or not in most cases before they give you the money. What they are doing is saying that by you just filing these 941Xs, these amended 941 payroll reports, and saying that you are due this credit, that you're due the credit. So I think that's really important for people to know that if you've gotten this credit and you're like, well, I guess I qualified because they gave it to me, that's not how this works. And the IRS can and will be auditing this significantly over the next several years. This is considered to be one of the areas that will have even more fraud than PPP. PPP went nuts because of the opportunists who wanted to get into the game. ERC is going to be even more. And I don't honestly think it's going to be the small business owners that are really the problem here, because most of them, ERC is complicated. And so they are using what they think is expert advice to claim these things. But oftentimes that expert advice really is anything but. Anytime there's opportunity and a lot of money out there, and this is one of those cases, you are going to have bad actors that are going to swoop in and are going to take advantage of it. And so I want you to be able to spot those bad actors, whether you've already used one, you're considering using one now. I really, really want to get the truth out there. I'm very, you can tell I'm very, very fired up on this one. And this has gotten really personal for me. I have had companies using my name in advertising to capitalize on my own audience that trusts me when it comes to the employee retention tax credit and other COVID relief efforts, right? I have had to send cease and desist letters out to companies, including big ERC mills, who are using my $27 spreadsheet in order to then calculate credits for companies and charge hundreds of thousands of dollars for that work performed. I kid you not, this has happened more than once. It is absolutely crazy. They're stealing intellectual property. They are doing anything that they can. These people don't really know what they're doing a lot of times. So really quickly, I'm just going to show you that the IRS agrees with me here, because some people have various different feelings about this, but I'm going to show you what the IRS has actually come out with. And I think this is what's really important to know as you walk into the employee retention tax credit. Okay, so you'll see here that this is on the IRS website. You can find this. This was issued in March. Now you'll notice that this isn't the first one. They are renewing this warning. So this is a renewed warning. This isn't the first time. They've been warning about this for months and months, since at least last fall. So the IRS issues renewed warning on employee retention credit claims. False claims generate compliance risk for people and businesses claiming credit improperly. So the IRS today issued a warning urging people to carefully review the employee retention tax credit guidelines before trying to claim the credit, as promoters continue pushing ineligible people to file. I have heard these stories firsthand about very aggressive firms who are telling people, yes, you qualify for this $26,000 per employee and you need to use us to file this credit for you. So the IRS and tax professionals continue to see third parties aggressively promoting these ERC schemes on radio and online. You may see this in places that look reputable to you. These promoters charge large upfront fees or a fee that is contingent on the amount of the refund. And the promoters may not inform taxpayers that wage deductions claimed on businesses' federal income tax return must be reduced by the amount of the credit. What does that mean? That means that if you claim this credit, you need to go back to your original tax returns, your annual tax returns for 2020 and 2021, and reduce the amount of payroll taxes you claimed as a deduction. What does that do? Well, that will almost always have the effect of increasing your taxes due for those years. And many of these ERC companies are not telling people that. Now, overall, you'll still end up netting an amount of money above and beyond those additional taxes, but you need to be aware of that, especially if the company that you are contracting with is charging you sometimes 15 to 20% of that total credit. So that means, and I've seen this, companies that maybe are on the larger side of companies, maybe they have $1 million or more that they are able to claim for ERC. But the companies that they are working with are then charging them $200,000 just to do the work that maybe takes them less than a day. And they might be using my $27 spreadsheet that they have illegally used my intellectual property without permission to calculate it. It's fine. It's fine. Do not go with anyone that is charging a contingent fee. I'm just going to say it. In my professional opinion, and if you look at Circular 230, you can Google IRS Circular 230, and that is related to tax preparers in the US. They are not able to charge what are called contingent fees. What's a contingent fee? Well, it's a fee that is contingent upon the calculation or the dollar amount, and that includes for tax credits. The reason that this is illegal, by the way, is to prevent exactly what is happening with ERC. The reason that this is illegal is because it basically creates an incentive for the company that is doing that work on the tax refund. If they're getting paid based on a percentage of what that amount is, then they are incentivized to take very strong, aggressive tax positions that may or may not actually be in line with tax rules in order to maximize the amount that they get. Now, what happens then? What do you think in a couple years when the IRS comes back and they say, actually, you didn't qualify for this at all, right? Where do you think those companies are going to be? They're going to be gone. They are going to be in the wind. I kid you not, that is what is going to happen. And so companies that paid hundreds of thousands of dollars or tens of thousands or whatever it is to get this work done as a percentage of the credit and the IRS is going to claw back that credit, they're not going to have anyone to go to get that money back. So this is why I feel really strongly about this. This does not mean that everyone charging a contingent fee is, taking advantage of people or is taking positions that they qualify when they don't. Sometimes you may actually truly qualify. There are a lot of people that do qualify for this. Again, we're going to talk about a little bit more about the partial or complete shutdown here in a minute with Christy, but just be aware that you're the one taking the position, and you can't blame, this, preparer told me that I qualified even when you didn't. You're still going to owe that money back, potentially with fines and interest and all the things. So just be sure that you qualify. Don't just say, well, I'm going to apply and see if I get the money back. You probably will, but that doesn't mean you get to keep it, and that doesn't mean it's really yours. All right, calming down. Now, just finishing, reading some of this because I think it is important, and I'm going to link to this down below as well so that you can read through this IRS warning. But it does say businesses should be cautious of advertised schemes and direct solicitations promising tax savings that are too good to be true. Taxpayers are always responsible for the information reported on their tax returns. You need to know that. You are responsible. Improperly claiming the ERC could result in taxpayers being required to repay the credit along with penalties and interest, like I just said. Okay, so it's not just me saying that. It's the IRS warning people, hey, we're telling you, make sure you know what's going on. Make sure that you are informed about this. This is why I do what I do, because I want small business owners to be informed. And then this talks about what the ERC is. I think another important thing here as well is this section here. So if you do believe that there are illegal activities, maybe there's a company that's coming after you strongly telling you qualify when you know you don't because you've been watching my stuff, then you can go to report tax-related illegal activities related to ERC claims. You can submit by fax or mail. I mean, come on. For real, IRS. This form and any supporting materials. Now, what I'm going to tell you, this is very frustrating when you click on this because I have a whole bunch of people that I want to report under this. But guess what? When I click on this, the form doesn't actually work. I've updated my Adobe, I've done all the things. The form does not work. So I'm going to find another place, hopefully, where this form is, and I'm going to attach it down below this video so that you can find this form because the IRS wants us to tell them, but they aren't really giving a great method to do that because this form isn't working for me or anybody on my team. So I've tried all different browsers. I don't know what's going on. You could also call the IRS, but I do think going through these channels is going to get it seen by the right people. Now, on the last YouTube video that I did about this, because I've been yelling about ERC scams for months and months now, but on the last video that I did about this, somebody actually wrote this comment in, and I loved this comment, and I hope that more of you feel this way as well. And she said, someone messaged me on Alignable asking me, how much do you know about the up to $26,000 per employee retention tax credit? I know where he was going with this, but I answered with this. Thanks to Jamie Trull, everything. I filed at the beginning of the year and received my ERC a couple months ago. Do you want her contact information? Y'all, please do this. Please do this. I love this so much. Okay, so without further ado, I'm inviting Kristi on here, and we're going to talk about a few things related to what she's seen actually in the field as she is preparing people's 941Xs, that's their amended payroll tax filings, in order to claim this credit. And she's going to give her thoughts on how you would qualify as this full or partial shutdown for government order, and what kind of questions should you ask anybody that you're working with to prepare this, and what kind of documents do you need to keep to make sure that you are safe in case the IRS ever comes back and asks you for additional proof. Okay, so let's jump on in. All right. Magically, I'm here with Kristi now. So this is Kristi Stone. She is a fellow CPA, but she works directly with clients where I am more education-based. So I love partnering with people like Kristi, especially people like Kristi. I mean, we have almost close to, I was thinking about it today, like 20 years of, we go back a ways.
Yes.
Which is kind of a weird thing to be able to say. But Kristi, I know they may have seen you on a couple of my other YouTube videos, but introduce yourself to everybody so they know who you are. And then we're going to jump into talking a little bit more about what you've seen in practice with ERC.
Sure. So currently I am just helping small businesses with the employee retention credit. What I do is I offer consultations to people who are trying to prepare this calculation themselves. And I also offer the end-to-end process where I work with the client and prepare their qualification documentation and then prepare their ERC calculation and prepare the Form 941Xs and mail those off to the IRS. So I can do the end-to-end process, or I can just help clients with any questions they might have. So I've seen quite a bit So I've been doing this now for over 2 years, I guess. I really started to pick up steam in January of 2021 when they changed some of the guidance. So I've been working pretty much exclusively on this since then.
So you are about as much of an expert, I feel like, as there can be on this subject, because this is your business. This is what you're doing right now. And I think that's awesome. Now, tell me, Christy, just because I just talked about this, how do you charge for such things?
Yes. Okay. So that's a good question. So when I'm just doing consultations for people, I charge based on the amount of time that I spend with the individual. But if I'm doing the end-to-end ERC calculation process, I charge based on the number of employees, the number of quarters, and kind of the level of difficulty of the calculation. So generally, it's based on number of employees and number of quarters. So the price goes up if you have more quarters and if you have more employees.
Which makes sense because that changes
factors. It can be like health insurance and things like that. It can factor in as well.
Right. Essentially, the more complicated, the more you would charge. You don't charge a blanket giant percentage of the credit.
Yes, I do not charge percentages.
Okay, so the first question that I wanted to ask was just around how long can people qualify for this? I think there's a little bit of surprise that a COVID era credit is something that we're still able to, as of right now, recording this in May of 2023, for the large part, we can still claim this, but how long, when is this thing going to kind of go away and be gone for good?
Technically, you can still file for the ERC for 3 years from the date that you filed your original 941. Right. And keep in mind that 2021 is when the more beneficial credit exists. So you still have a good amount of time to file for that 2021 credit.
I talked about in the beginning of this video how there are a couple of different ways to be able to qualify for this. The drop in gross receipts, which gets a little complicated and we're not going to get into here, is probably the, I won't say easiest, but it's the easiest way to really defend, right? But if you don't qualify for that, or if you're looking to see if you would qualify for more under the partial or complete shutdown by governmental order, what the heck does that mean? Because I know that's the one that there's a little bit more question about. It leaves a little bit more, to the imagination to figure out how would you qualify for this and how do you defend it?
Yes. Okay. So that's a great question. The partial suspension is definitely a more gray area. The keys to the partial suspension are that you need 2 things. The first is a governmental order that was in place that impacted your business operations. And then the second is explaining how that governmental mandate impacted your business. And what the IRS wants to see is that governmental mandate had a greater than nominal impact on your business. You need to be able to evidence to them that a mandate existed and also evidence to them what the impact of that mandate was on your business. And that's really what the IRS is going to look for.
Got it. So what are some of the things that maybe some examples of things that you typically could see qualifying versus some things that maybe wouldn't, just to give people a few of those common scenarios?
Yes. Okay. So an easy example of a qualification would be if there was a dine-in restaurant. So the restaurant primarily serves dine-in customers. And then there was a governmental mandate in place for a set period of time that stated that restaurants could not offer in-person dining. They could only offer takeout or delivery. So in that case, for restaurants whose business was largely based on dine-in customers historically, they would qualify based on a governmental mandate because they were not allowed to have that dine-in service for that period of time. An important thing to keep in mind is you only qualify for the period of time during which that mandate was in place. So if there was a mandate that started March 21st of 2020 for that restaurant and it only went through June 21st of 2020, you could only take the ERC for wages paid during the time of that mandate. You don't qualify for the whole quarter just because you have a mandate. You only qualify for the period of time during which that mandate was in place. Restaurants are a great example. Fitness studios are another great example where they had to first of all, a lot of them had to completely shut down because of a governmental mandate. And then when they were allowed to reopen, they had to reopen with significant safety measures in place. They had to reduce the number of customers that they let into their facility. And if those things had a greater than nominal impact on their business, they could be considered a partial suspension. Now, I have seen situations where there's governmental mandates in place, but they don't result in a greater than nominal impact on the business. So an example there would be, so let's say there was a governmental mandate in place for a period of time, but all the governmental mandate said was, we recommend that people stay home. But they didn't require that people stay home. They just said, for this period of time, we recommend people stay home when they can. In that case, that recommendation is not enough to be considered a mandate. And in that case, they would not qualify for partial suspension based on that recommendation. It has to be a mandate that the government says, X business or these businesses need to shut down, or they need to limit their hours, or they need to reduce their services. They can only do these services, but not these services. So it's key that it's a mandate and not just a recommendation.
I think another thing that has come up sometimes is the idea of like, if people were able to work remotely, right? Like if your entire staff could go work remotely, that wouldn't be, even if you couldn't go into the office, that wouldn't be considered a shutdown, right?
Yes. And that's such a great example. Yes. So if you're able to transfer pretty much all of your work to a remote situation, you really wouldn't be significantly impacted by that governmental mandate.
Yeah. One thing that I've seen come up a lot is this idea of like supply chain disruption, right? Like qualifying based on supply chain disruption. What have you seen with that? Is that something that is likely, what would they have to show? And would that be something that would even qualify?
Yes. Okay. So the tricky thing here that you have to keep in mind is if you have a supplier and you're trying to make the argument that you qualify based on this supply chain disruption, you have to be able to point to a governmental mandate that impacted your supplier in such a way that they were not able to produce the products that you need to continue operating your business. In addition to that, the IRS also says that you have to not be able to get those supplies from another supplier at the same time. So I'm trying to think of a good example there. I mean, you might work with a supplier in California that was under a governmental mandate that prevented them from manufacturing the product that you needed. But you could find a supplier in another state that was still able to manufacture that supply, and you were still able to get what you needed from them. In that case, you could not make the argument that you had a supply chain disruption. Also, if that supplier if they don't have a governmental mandate and they were just low on employees, I saw a lot of that. A lot of people were low on employees during that period of time, but there was no governmental mandate that actually directly caused that. In that case, you cannot make the case for a supply chain disruption. It has to be a governmental mandate that caused
I think that's really important because I have seen this. I think this is one of those kind of what they consider like a loophole that some of these ERC companies are pointing people towards, that if there's any kind of supply chain disruption, well, who has a supply chain wasn't somehow disrupted, but was it actually due to a governmental order or just some kind of other offshoot of, the pandemic or employee issues or whatever else, right? Could they have gotten it from somebody else? So I think that's really important when you're claiming this to understand. And I think if you're working, we're going to kind of talk about like how to know if you're working with somebody, if you really qualify or not. If you're trying to qualify based on something like this and your provider is not asking you these types of questions, then you probably need to think a little bit about whether they are qualified to do this and whether you're going to be protected in the case of an audit, right? So let's talk a little bit about that. About what happens, so let's say you get the credit. And one of the things I talked about earlier in this video is, hey, just because you get the credit doesn't mean you qualified. It's not, there's no, process by which they are qualifying you and that you can just try and see if you get it. And if you get it, well, I guess you qualified. So that has been kind of one of those things that people have talked about, but don't do that by just the simple act of applying. You are asserting that you qualify for this. So what do you need to have then? First of all, how long can the IRS look at this? I mean, basically the answer is for a while, for several years, they can come back And what do you need to have to protect yourself? Either if you're doing it yourself, what do you need to gather to have? Or if you're working with somebody, what do you need to make sure that they give you in order to protect yourself down the line?
Yes. Okay. So there's a couple things. If you qualify based on a governmental mandated partial suspension, what you're going to need to get from that ERC firm is, first of all, they should be pulling together any governmental mandates that were in place that may have impacted you. And then they or you should be explaining why that governmental mandate had a greater than nominal impact on your business. So that can be in memo form, that can be in Excel. They just need to have retained copies of the governmental mandates and also explained the impact. Those are the two things the IRS has said they're looking out for on governmental mandates. If they qualify based on a gross receipts reduction, then of course you need to have copies of your quarterly P&Ls for each of those quarters to evidence that you had the required gross receipts drop. And then lastly, in terms of the calculation itself, the IRS is going to be looking for detail of how you calculated your ERC credit. And also they're going to be looking to see how you pulled out your PPP funds. So if you had PPP during the period in which you qualify for ERC, they're going to want to see your total wages, and then wages allocated to PPP, and then wages allocated to ERC to ensure that you're not double dipping in any way. So the key overall is just going to be documentation. Just make sure that you have it for your qualification and your calculation. Now, one thing that I do see with some of these ERC mills, it seems like they're telling people they qualify, but they're not actually providing them with their qualification documentation up front. I would say the first thing you should expect from someone who's preparing your ERC calculation is documentation of why you qualify. If they don't give you that, then I think that's an immediate red flag. You should be concerned. You need to ensure that you've evidenced why you qualify before you even dive into the calculation at all.
All right. Well, thanks, Kristi. How can people reach you? I'm going to put your link below. So if you want to reach out to Kristi, definitely go check that out. Again, she has very limited availability, but if you can snag a spot with her, obviously I highly recommend it.
Yeah, so
that's what to ask, right?
Yes. So that's really the best way to reach me is through that Calendly link. I also have a website. It's www.stoneandcompanycpas.com.
Awesome. Well, thanks again for joining us, Kristi. I mean, I guess I keep thinking that this is going to be our last discussion on ERC, but I'm sure we'll be here in another 6 months talking again about ERC.
About something related
it's never going to go away, I guess. It's going to be the gift that keeps on giving. And then, Kristi, you can just pivot to audit support. That's the next iteration of this, I think. Is helping people who didn't get that support up front to have it when needed.
Yes, that's so true.
But anyway, well, thank you as always for joining me, Kristi, and we'll talk again soon. I know this was a long video. Thank you for making it all the way to here. Please share this around. Kristi and I are both really passionate about making sure that people understand all the ins and outs of this and that they are not applying for something that they don't qualify for, or that they're not using somebody who really isn't the best person to be preparing this work for them. So please share this around, share your experiences in the comments below, and I will see you next time. Bye for now.